One of the most important tools traders can use is regression. All markets eventually regress to the mean. I'm going to look at several markets here. We'll start with oil. I noted this breakout here at 67-ish. And once oil broke out of that, the next resistance zone is at about 76. Let me widen the chart. So this is our next resistance zone right here. Once this breakout occurred, it occurred early in the daily cycle. That indicated that it should have a sustainable move. That's what we're getting. But this is what many traders ignore, especially when you start to get a trending move like this. They ignore the stretch above the long-term mean. So in this case, I'm using the 200-day moving average, and you can see the price is getting stretched very far above this mean. But as these momentum moves progress, emotions take control, and traders just assume that the trend is going to continue indefinitely. And what they should do, any time a market gets stretched a long ways above a long-term moving average like this, it becomes dangerous. So I do think oil is probably going to hit this resistance zone, but if it does it quickly, it's going to be stretched extremely far above this long-term mean, which probably means that it is not going to get through this resistance, and there's probably a good chance that we'll have an intermediate degree correction once this resistance is tagged, something that'll take price back down and correct some of this huge stretch above the 200-day moving average. And traders that are trading based on their emotions and based on the strong trending move and their expectations that that move will continue into the foreseeable future, they'll get caught and they'll ride that corrective move back down and lose most or all of their profits, especially if they started chasing late in here. All right, now let's move to another market. All right, this is Bitcoin, and I tried to warn people here. At the top here, Bitcoin was stretched 150% plus above this 200-day moving average. I think at this point it was over 200% above the 200-day moving average. Extremely dangerous market this far above the moving averages. But as most of you know, at the time, all we were hearing was calls for 100,000 or Bitcoin is going to $1 million. So people had let emotions take over instead of logic. And any market that's stretched 150 to 200% above the 200-day moving average is in a bubble, almost certainly, unless it's coming out of a major bear market. Then sometimes you can get a big stretch like that will then at some point go sideways for a long time and allow the moving average to catch up. But that's obviously not what happened. We've had a huge crash off that top. I'm still seeing people expecting that this is going to recover very quickly, and still seeing calls for 100,000. That's what happens when a bubble pops. The advancing phase just convinces everyone that there's some fundamental reason for price to go this far. And really the reason has nothing to do with fundamentals. It just has to do with human emotions. And then what happens is you get the stair-stepping down process. So when we got this first leg down, we made a lower low. That was the warning sign. And yet I saw a lot of people expecting a quick recovery and a move back above 65,000. I warned people that these moves almost always play out at least as an ABC move, and if we're starting a bear market, it's going to be bigger than that. But a lot of people buying here because they still had that mindset that had developed during this huge move. And then, of course, what happens is they get caught in the second leg down. We're getting a small bounce here. Almost certainly, same thing's going to happen. When you stretch this far above the moving average, it's very unlikely that price is just going to come down, tag that moving average, and then back off to the races. If we'd had a reasonable move, something, uh, in this area, then yes, you could come back down, tag it, and keep going. But if you're stretched 200% plus above the 200-day moving average, then almost certainly price is going to go far below this 200-day moving average before this collapse is done. So again, warning signs, control emotions here. All right, let's move on to the S&P. All right, again, you can see how far price is stretched above the 200-day moving average. It's getting excessive. Now, we could just take off into the final bubble phase, and during that, then as we saw with Bitcoin, price can stretch an obscene amount above the 200-day moving average. But I don't think we're quite ready for that yet. We're getting pretty late in this intermediate cycle, so I suspect we've probably got another trip back down. Something I doubt that it's going to get back down to the 200-day moving average. I think central banks are protecting the stock market and they're just printing too much money. But I do think we've got to either correct or we're going to have to go sideways. So let me switch over to the NASDAQ. You can see it pretty clearly here. Price got stretched way too far above the 200-day moving average, and then what has happened is we've been in this choppy sideways market, allowing this 200-day moving average some time to catch up to price. We're bumping up into that resistance zone at about 14.2. Again, it's coming very late in this intermediate cycle, so I doubt we're going to get a sustained breakout, maybe a marginal breakout. And usually what happens is smart money they'll actually manufacture these marginal breakouts, and then they sell into them, and then the market turns back down and corrects again, and all the retail traders, they buy into that breakout thinking that we're going much higher. And if we were getting a breakout early in the intermediate cycle, I would agree, but I think we're going to have some more sideways here before we can start the final melt-up phase. So I most definitely would not advise anybody to short the market. We're at least in the middle phases of a bubble, and shorting in a bubble is suicide. So you don't want to be short, and you probably don't want to be out, but I don't think you want to be leveraged at this point right here. Because I suspect after the FOMC meeting, we're probably going to get some kind of corrective event again, and then we may have to go through another complete daily cycle of this sideways chop before we're ready to break out of this. And then when we do, then I think we do start the final melt-up phase, and price stretches 40 to 60% above the 200-day moving average. But right now, I think we're building the base for that, and I don't think that we're done yet. I think we've got some more sideways on this before we're ready to really blast off. All right, here's a quick look at copper. Same thing, just stretched way too far above the 200-day moving average. It needs some kind of corrective event, or it needs to go sideways for many months and allow this 200-day moving average some time to catch up to price. At this point anyway, it looks like it's trying to correct back down towards the moving average. So nothing unusual here. It doesn't mean the commodity bull market is dead. It just means that emotions got a little overheated and pushed price a little too far above the long-term mean, and now we've got some profit taking going on here, and it should continue for a while. These profit taking events usually require some time. Now, the one area that isn't stretched, and this is the area that I'm intensely interested in at the moment. All right, this is the gold chart. You can see we're not extremely stretched above the 200-day moving average. We were here, and then you can see exactly what happened. You stretch too far on the upside, you come back down, and you overcorrect on the downside. Now we're in the process of trying to recover that 200-day moving average again. We're in a daily cycle low. Um, in my last video, I had noted that, you know, I wasn't sure if this was a final low, and then in my, I think the last video I did, I noted that there was probably going to be an attack on the metals to create an undercut. That's what they did. Tagged the 200-day moving average, bounced yesterday. They're hitting it again today. The FOMC meeting tomorrow is a potential trigger event for this cycle to bottom. If it didn't bottom yesterday, I kind of think they're going to maybe try and break this 200-day moving average. That would create a larger selling panic, build more fuel for the next leg up. But we're very late in a very stretched daily cycle. We're moving down into the daily cycle low. This is not a market that is stretched a long way above its long-term mean. So this is a market that I'm interested in trying to get into positions. It may still be a day or two early here, but this has the potential. Once this is done, we have the potential to repeat, you know, this kind of a move or bigger once this daily cycle correction has run its course. You know, based on regression principles, I'm much more bullish on this chart once we finish this correction than I am stocks, copper, oil. Although, like I said, I think oil still has further to run, but I think once it reaches that 76 to 77 resistance zone, then we're going to have we're either going to have a pretty big correction back down, or it's going to be stuck in a sideways consolidation for multiple months. So it's starting to get late in that oil cycle. Probably not a huge amount of potential left. And then you got to make sure you don't get caught in the correction. Gold, on the other hand, is late. You know, it's getting deep into its correction. We've had the undercut. Maybe they hit it again tomorrow and try and break this 200-day moving average, but we're due for a bottom here any day now. So and we're not stretched. So the potential is there for a really big move to the upside once this daily cycle correction is finished. And as I've said in some of my previous videos, I think there's probably nowhere where the potential is greater than in silver. Again, not stretched above the 200-day moving average. Kind of appears that maybe silver is in a triangle consolidation. No guarantee that's going to play out. It looks like it at the moment, but it's not impossible for silver to come down and break below this and give us a lower low before this daily cycle bottoms. But it's going to follow gold. So when gold finishes its daily cycle correction and then starts the next rally, silver will too. And then in silver, we have this huge consolidation. Silver has just been holding up extremely well while gold and miners have been correcting. It's just been stuck in this long sideways consolidation. It's worked off this extreme stretch above the 200-day moving average instead of a really nasty pullback to or below, like gold, below the 200-day moving average. The fundamentals in silver and the supply and demand are stronger, and silver, instead of correcting like gold has, is mostly just been stuck in a sideways consolidation. So I think the potential in silver is considerably more than gold once we finish this daily cycle correction. And I think once we get a breakout above 30, which I think is going to happen during the next daily cycle, I think that's going to send silver to 40 pretty quickly. And if you get to 40, then 50 is going to start pulling the price higher like a magnet. So I think there is a potential for a move to at least 40 and maybe even $50 during this next daily cycle once we finish this correction in silver. So of all the markets, and based on regression principles, most everything is just getting too stretched above the moving averages, too dangerous. I'm a bit leery about those markets. I don't want to be pushing leverage in those markets. whereas the precious metals market is in a minor daily cycle correction. It's late in that correction. Neither of the markets are stretched extremely far above their moving averages. So the potential to make big money is in the metals over the next couple of months once we finish this correction.